Brad Hunter of Hunter Housing Economics. Welcome to Inside SFR BTR. We're excited to have you. You're going to be moderating the third session of our executive order panel, focusing on what this industry is really all focused on right now. So really appreciate you coming in. Tell us a
Thank you.
little bit about Hunter Housing Economics.
Thanks, Gregory. It's great to be on with you. So Hunter Housing Economics is a firm that does site-specific market studies. We are doing studies nationwide, and we're best known in the BTR area, although we also do market studies for sites that are apartments of all types, condos, single-family subdivisions, and so on. But we have a fantastic team, and one of my team members is joining me. She'll introduce herself in a few minutes, and so we're excited to just track and keep up with all the craziness that's going on in this industry.
You have a prestigious panel, and we're excited to meet everybody.
Well, thanks. And I'd like to have each of the panelists introduce themselves. So let me kick it over to you, David, our policy expert.
Thanks, Brad. Really appreciate it. Happy to be here. Really enjoy participating in these sessions. David Howard, I'm the principal and founder of Real Estate and Housing Advisors, which is a policy-focused shop here in Washington, D.C. I work with clients to provide intelligence and insight on legislative and regulatory issues, both at the federal and state level, impacting housing providers, whether they be owners, operators, builders, investors, based here in Washington, D.C. Prior to starting this firm earlier in 2026, I was the CEO of the National Rental Home Council for 6 years.
Matt?
Founder and CEO of Lending One. We're one of the largest debt providers in the build-to-rent space, also single-family rental and scattered strategies, and we've really been along for the ride as the space has matured and become an institutional asset class. So we've been happy to support the growth over the last 10 plus years of the industry. We, again, have been very, very active in the build to rent over the last 24 to 36 months and have been one of the largest proponents of supporting the growth in the space.
Great. It's good to have the capital perspective on this session as well. Absolutely. Andrew, tell us about your perspective and Blue Vista.
Yeah, thanks for having me, Brad. Andrew Schaffler with Blue Vista Capital Management. I oversee our BTR investments and platform here. Blue Vista is a middle market real estate private equity shop with a significant focus on scaled residential strategies. And excited to be talking about BTR.
We're excited to have you. I met you when you were working as the head of BTR at Roofstock. And so you bring a tremendous amount of experience and knowledge here. And from my team, Audrey Herrero.
Yes, thank you. Audrey Herrero. I'm a senior consultant specializing specifically in build for rent at Hunter Housing Economics. My background is actually in architecture and financial underwriting, so I take a very special emphasis on marrying those two into product optimization and financial engineering so that we can have our maximum NOI. Excited to be here and excited for this conversation.
Yeah, and that's very modest because Audrey also has the perspective of having looked at hundreds of BTR projects across the country. She used to work at SVN SFR Hub as the head of BTR there. And so what a fantastic panel. Really happy to have you all on. Thank you for joining. We're going to talk a lot about the executive order as well as other legislation that's going to affect our industry. But I want to save that. I want to first kind of hit some of the broad topics such as supply and demand. And with that in mind, I want to start with you, Andrew. We talk a lot about the supply cliff, how there's going to be a huge drop in the number of deliveries of BTR units hitting the market this year, and especially in 2027. And from your perspective at Blue Vista, how do you think about what effect that's going to have on the opportunities that are coming up?
Yeah, I guess before I jump in, probably should mention the views online and not necessarily those of Blue Vista, but happy to speak to that question. Look, we are seeing supply curtailed and specifically in the build to rent space. At the same time, build to rent is still a small sliver of the overall residential market, both ownership and for sale, single family, as well as multifamily rentals. So certainly hopeful to have that tailwind here as we enter 26 and into 27, seeing a lot more discipline on the part of developers and a decline in overall starts. I think at the same time, while multifamily has also seen some declines, we actually saw some specific markets in the Sun Belt, some of those higher growth markets that have also been higher supply markets like Houston or Orlando or Denver, actually see a pickup in their permit activity in calendar year 25 relative to 24. So I don't think we're totally out of the woods in terms of overall supply. And it probably means absorptions and some of the recovery are pushed out a little bit. So we're certainly not expecting any kind of hockey stick rent, but we see healthy income growth across the spectrum, relatively stable job growth, although that's day to day and report by report, given some of the ongoing macro shifts. And so we would expect at least a partial recovery in build to rent as we go forward here.
Yeah, and I would agree with you. It won't be a hockey stick return of rent growth, but our research is indicating that it's going to be pretty fast when it turns because there's going to be so few units reaching completion at the same time. It's going to be a different, more positive supply-demand environment for sure. And by the time projects start coming out.
Yeah,
All right.
I mean, we see that at the project level where there was a very small microcosm of supply specific to a project or a bunch of lease ups going on at the same time. When that inventory has gotten absorbed, since there's very little coming behind it, you are seeing these moments of a gap up in rent and really a pickup in the renewal rates, upwards of 80% in a lot of circumstances. So there's certainly the potential for hockey stick, but I think our industry would be wise never to underwrite that. We've seen some of those underwritings in the past, and we should maintain that discipline.
Everyone is being conservative right now, that's for sure. So it's better to be a little on the safe side, but I also see a lot of folks that are too reticent, in my own opinion, just me talking, to get involved early and kind of roll the dice a little bit. But one thing that's easy to forecast is deliveries. When you know what the starts have done and they've collapsed, deliveries are going to be down too. So it's pretty easy to forecast that things are going to get a lot better.
One thing to keep in mind too is when we're looking at rental data, typically you're looking at multifamily combined with build for rent. And so it is important to separate those out and really look at the competitive build for rent communities and how they're operating. What is their rent growth? What is their absorption? Typically at Hunter Housing Economics, we see that compared to multifamily, build for rent is still stronger. That's going to depend on the market, but it is important to differentiate between those two data sets.
Yeah, good point.
Yeah, I think in the primary markets, the larger Sunbelt markets, I think it's just important as you think about the distinctions of multi and build to rent, where there is an oversupply in multifamily, operators and landlords are offering significant concessions, not a normalized amount of, let's say, 1 month, through a normal lease up. That's where you start to get into trouble, where you're seeing residents hang on longer in a multifamily lifestyle, even if it's not ideal for their family or situation, just because the economics and affordability are so compelling. And so really what we just need to see ultimately is a normalization in multifamily to the regular way permits and starts. And that should allow BTR to kind of separate again and be a little bit to its own drum. And you see that in some of the secondary markets where there is less supply. So there's certainly credibility to that.
Yeah, that's right. And we got to keep on harping on that. The advantages that BTR offers is over multifamily, private outdoor space, fewer shared walls, and those things are extremely valued and really not overly abundant in a lot of markets. But Matt, let me kick it over to you with this next question, and it kind of segues right off of what we were just talking about. BTR is getting a lot of attention, and the purchase of ResiBuilt by Invitation Homes is emblematic of that. How important do you see BTR being in the broader marketplace going forward?
Yeah, we've seen this shift over the last few years. So I think right now, with a lot of the discussions that are, particularly coming out of Washington and others, it seems like there's a spotlight on the build to rent space. However, if you think about how this space has developed over the last, say, 5-year period, it was relatively nascent 5 years ago, and then quickly became institutional asset class that people were very interested in. Really, over the last, again, I think about 24 to 36 months, if you look at broadly all of the institutional ownership in the country, and you look at what have they actually done with their portfolios, the net sell, sort of number of scattered homes sold in most institutional portfolios, they've been net sellers. Now, where they've been adding and why their portfolios have been growing or staying stable at bare minimum is there's a sale of the scattered strategies and rolling into a build to rent strategy. So we have seen that pick up over the last few years, independent of any new talk that we've had over the last 2 months related to industry updates and coming out of Washington. This was a trend that was already happening, and I think that's really critical to understand right now that build to rent has been a solution. It's been growing in institutional asset class very rapidly. We have seen both from the residential side, capital and credit come in. And then we also saw the multifamily space start to enter over the last period of time, meaning you owned 20,000 multifamily units. Historically, that was how you ran and operated and thought that was a growth platform for you. Now they've added build to rent as an acceptable asset to be able to add to their portfolio, and it really accelerated the growth of the industry that you had multifamily capital coming into the space where before, again, 5 or 6 years ago, that was quite rare. So those are a lot, and scattered being less popular strategy for a lot of reasons. Values from a residential home have, as we saw post 21, were up in some markets 50% or greater. And the rents, although have grown quite a bit, have not kept pace.
Yeah, and part of that is BTR is adding supply, and President Trump, everybody else is all in agreement that we need more housing in the right places at the right kinds of rent and price levels. And BTR helps to meet a need that that really exists in the marketplace. Andrew, I want to come back to you again and find out from you what markets you think, geographically speaking, are the ones to look at. And in particular, what are your thoughts about the secondary markets? And just to preface that, a lot of players are saying, oh, we're being told by our capital, just stick to the big primary markets. But how significant is the opportunity in the secondary markets now?
Yeah, it's pretty significant. I'm glad you asked about some of the secondary markets. I think the key for all of this, primary or secondary, is affordability, right? One of the reasons that a lot of these primary markets came up the curve even prior to COVID and some of the migration patterns were because of the affordability and lifestyle. And the affordability piece, which everyone's focused on from the administration down to private capital, that's what's creating the challenges. And so you are seeing a population migration now to some of these secondary cities where folks can get that same quality of lifestyle, but at a more affordable absolute price. And so there are opportunities in some of these lesser supplied markets that also have that affordability component going for them. And the key is really to continue to have our industry deliver entry-level product that's affordable to the masses in all markets, so that primary markets can also deliver on that promise. I'd say there's a couple of markets specifically that I think are interesting. Our development affiliate arm, Peak Made Properties, is currently developing some property in Kansas. And that's a good example of a market that just hasn't had the levels of supply that some of the Texas markets or Georgia or Carolinas markets have experienced, and yet the fundamentals are very sound. Very similar job growth, and now in migration patterns to cities like.
Yeah, right. So, and that kind of dovetails with a lot of the research we're doing too, that finds that the absorption paces are challenged right now in a lot of markets, and chunk rent is a key. So if you can be below, say, 2,800 a month, you're going to get a lot faster absorption than higher than that. And that's where the secondary markets really actually tend to shine.
Yeah. For some of the capital that focuses exclusively on primary markets, there are some that are turning the corner. I mean, while maybe Phoenix and Houston and Dallas still have a bit of absorption to go overall, Atlanta's turning a corner. Raleigh sits kind of somewhere in between a primary and secondary market, but benefits from that affordability in absolute terms that I described, as well as some of the job growth and university systems that occur there. There's an interplay between the two markets and opportunities in many of them, particularly if you have very patient capital for some of those extra large markets.
Yeah, that's true. And we found that too. We've done studies recently in Raleigh and Kansas City and found very positive opportunities there. Matt, let's talk about the debt and equity providers. Are they coming off the sidelines now? Anything?
So I think there's, as we think about what happened is you really came out of COVID, we had record low interest rates, as we all know, really that spurred across all asset classes, a lot of deployment and a lot of I think equity returns that were dependent upon effectively almost zero interest rate policy. So as you shifted out of that time frame into 21, 22, as rates came up in 22, 23, we saw really both the deployment from some of the equity side drop off. And I think really, if we take a step back of what really fueled the build to rent industry, there was a few very large counterparties. What was very prevalent was there was a local operating partner who understood how to build or source assets. And there was an institutional capital source, whether that was, a private equity firm or some type of insurer, who was really the most of the capital coming in to support those transactions. Really, when interest rates went up, the returns became a little bit less attractive. Those 4 or 5 main counterparties pulled out in a similar time frame. So you had a lot of liquidity from the back end pull out of the space in a relatively condensed time frame. And then you saw, as you described, the supply sort of cliff. Really, that's when all of the halts came in the build to rent sort of permitting and new builds coming out of the ground. And that's why now you sort of have some residual projects, but you don't have a lot of new projects that were started, say, from 23 some time frame on. And you sort of have this gap that exists of new projects that were permanent or coming out of the ground around that time frame when the capital was a little bit more challenging. Now, we've had the benefit of a little bit of rate drops at this point. I think a little bit of settling on the asset class of being desirable. And as we talked about earlier, where can you put out capital in a large scale and institutional format? That really sets up very well for build to rent. So if I want to deploy $20 to $50 million into an institutional project, that is very challenging on a scattered basis, but that is a very manageable size build to rent project. So I look at that as the catalyst broadly of, there is capital to deploy out there. Yields in other asset classes are very compressed, and it's there. At some point, you do need to deploy. So I think there's all those dynamics happening. When it relates to the debt side, debt's been readily available, broadly over the last few years. So we've been lending very actively the last couple of years, among some others. So I think the debt side is there. It was just, can the equity pencil the debt? So as even though like we think we're reasonable in terms of where we're lending, it's still, if you have a cap rate at you're building to a 5.5 cap rate or 6 cap rate even, and your debt's above 6, that becomes hard to deliver to your equity partners the returns you need, particularly coming out of a private equity side vehicle that needs to hit mid-teens returns or somewhere in that range. So you need the rent growth or you need cap rate compression, and a lot of people don't want to make that bet over the last 24 months. So net, that's why we've seen less activity. But what I do know is that as a space in build to rent, the amount that the space has become known now as a legitimate commercial real estate asset and a residential institutional asset class, over the last number of years, the viewpoint on that has become much more favorable broadly from both the debt and equity side and institutional capital partners. So I'm relatively bullish over a longer period of time about the amount of capital that will continue to come into the space from both the debt and equity side.
Yeah, that makes sense. And, I think that the groups that do kind of move first are going to do incredibly well because I think that's the supply cliff is real. Rent growth is going to be real, even though nobody wants to include rent growth in their models. I think it's going to be assured. So, David, let me come over to you now. There's a lot to talk about, a lot to unpack. President Trump has made some proclamations, and we all know that affordability is a problem. It is a real severe problem. But we also, I think, all agree that banning institutional purchases of single-family homes is not going to solve that problem. What I like about the executive order is that it excludes build to rent. And that's because President Trump knows that supply is needed. We need more housing in the market, both rental and for sale. But the key thing I think that still has to be sorted out about the executive order is the definitions that are outlined. So the definition of institutional investor turned out now to be, according to the Wall Street Journal, and maybe you can corroborate, 100 or more units, which is not, to me, institutional. That's just a average size investor at best. And then the other one I wanted you to talk about is the single family definition, and what does that include? how should we all think about how these things are being defined and what that means?
Well, we're at a really interesting point in that the executive order came out on January the 19th. And, it's interesting. I read it through late in the afternoon on the 19th. And the first time I did so, I thought, oh my gosh, this is really going to be bad. But the more times I read through it, the less bad it really became. That's not to say it ever got to a point where I would consider it good. It certainly wasn't that, but it did become less bad. And the reason for that, there were some nuances in there that I wouldn't say benefit industry, but maybe provide some positives for industry given the general context. There was a lot in the executive order that wasn't said. As you mentioned, there were some key definitions that weren't really addressed. There wasn't a lot of clarity around things like build to rent. There were some mandates, some expectations that were built into the executive order mandating the Department of Treasury, the FTC, some of the other agencies, HUD, FHFA, to do certain things. There were very few timelines. A couple of the provisions had some timelines in terms of expected deliverables, but it was kind of a strange and peculiar document. I've been through a number of situations involving executive orders over the years, and usually an executive order is pretty direct, because when you think about what it is, an executive order is the president saying, I'm going to do this, and here's how I'm going to do it. This one didn't really accomplish that. Again, it wasn't particularly direct. It had a very strong headline, but again, there wasn't a whole lot beneath it. And so I think that just left a lot of people wondering, what is this and what's next? And over the subsequent weeks, we've learned a little more. We've been able to piece together a little more about perhaps where legislation is going that will codify the executive order. I do believe there will be legislation, and that we'll probably see something over the next, I would say, 2 to 4 weeks. I do think there will be a fairly broad exemption for build to rent. We'll have to wait and see what that means. But the fact that there was a provision in the executive order providing for build to rent, I think is important. To your point, it's an acknowledgement on the part of the administration that build to rent does have an important role to play. To your comments about institutional investment and kind of the targeting of large owners, the targeting of corporate owners, institutional capital, affordability is a real problem when it comes to housing. There just isn't enough. There's a supply problem. I think that's widely accepted and widely acknowledged, even by this president, who has spoken on numerous occasions about the fact that we're just not building enough housing. And that includes housing of all types, whether it's for sale, single family, whether it's multifamily, traditional apartments, or whether, in our case, it's single family rental housing. And so my view is we need to do everything and anything we can to make sure that we're delivering as much housing as we can,
Right.
almost regardless of where the capital comes from, who the owner is, or who's building. And then maybe lastly, to your question about some of these definitions, you're right, we have gotten a little bit of clarity over the past week or so on what a couple of those key definitions are. The definition of an institutional investor is any owner that has 100 or more homes, and the definition of single family housing includes traditional detached single family and what they refer to as semi-detached. And really what they're talking about and even identify are townhomes, row houses, and duplex and similar kinds of similar. The reality is any owner operating at scale is going to fall under the definitions of institutional owner and single family housing.
So, David, I want to stick with you on this, because one of the things we talked about here just now is the importance of that carve out for BTR and how that is badly needed. However, at the state level, a lot of legislation is being forwarded, sometimes pretty aggressively. And so you see that, I think it's like 40 or 50 bills in 25 states that are being forwarded right now. And what scares me is that in some states like Georgia, Virginia, Tennessee, you've mentioned to me, don't have a carve out for BTR, and they have some legs, right? So what's the extent of the risk there, and how misguided are these state level policies to not have that carve out?
That's a great question, and it brings up a very good point, which is so much of the action in housing generally and single family rental housing, build to rent housing specifically takes place at the state level and even the local level, the county level, the municipal level. And so if you're in this space, again, either a traditional scattered site, build to rent, some combination of the two, you really need to look at what's happening at the state level. I'm involved with legislation in 27, 28 states, which account for between 40 and 45 separate pieces of legislation that seek to either restrict the acquisitions of single family homes by so-called institutions or limit the number of homes that institutions can own. And so there are lots of other bills out there. There always are every year that sort of govern things like the operating practices of rental housing providers. But what I'm talking about here are bills that follow along the same lines of what's happening in Washington, D.C. in terms of this executive order. And I should point out, this sort of thing has been around for a while. This really isn't new. States, particularly more of the left-leaning, progressive, blue states, certainly the Californias, the Washingtons, the Oregons, to some extent Colorado, those states have been trying to accomplish this for a while. I mean, when I was at NRHC, it seemed every year there was a bill in California that sought to limit the number of homes an institutional investor could own. And what's interesting though now is we're starting to see that practice seep into some of the red states, some of the more conservative leaning states. We really started to see that for the first time last year, and that's really only picked up this year. What's happening is a lot of the legislatures in some of the more conservative states, the Georgias, the Floridas, the Carolinas, Tennessee, and some others, they really feel emboldened by what's happening in Washington, D.C., specifically the position of the president. They feel that if the president is behind this issue, and certainly he's making pronouncements that he is, that sort of brings some wind to their sails and gives them the momentum that they feel they need to get something done on this issue. And so again, to your point, we've seen some legislation in places that 3 or 4 years ago, I would have been very, very surprised to see anything. Again, Georgia, Florida. Last year, there were a couple of bills actually in Texas. There's a really bad bill in Nevada. Now, Texas and Nevada are not in session this year, thankfully, but this is certainly a trend that is going to continue through 2026. And the other thing that's important to remember, I don't believe this is an issue that's going to go away. I think policy risk is here to stay for this industry. I think, frankly, it's, barring some kind of catastrophe in the housing market, a la the great financial crisis, which I don't think anybody on this call sees repeating itself, but barring something like that, I think policy risk is really the biggest threat to the industry, both at the federal level and the state level.
Mm-hmm.
From what I've seen and from a lot of the meetings and conversations that I've had here in Washington, D.C., I'm not sure the legislation that comes out of DC is going to be terribly restrictive for industry. Please don't email me and challenge me on that front. That's just one guy's opinion. That's my sense. I don't think there will be a preemption on any states contained in the federal bill. In other words, people have asked me, well, do you think there will be something in the federal bill that prevents states from passing their own legislation? I don't think that will be the case. Therefore, I do think that 2026 is going to be the year that we see a lot of these bills pop up at the state level. And I think that's going to continue in 27 and 28. And then I also think there's continuing risk at the federal level post the November elections. If you subscribe to the view, which I do, that Democrats are likely to take back the House in November, I think they're going to come at this again. And so I think in 2027, this is going to remain an issue here in DC, regardless of what happens here over the short term in terms of federal legislation. So, again, I think between what's happening at the state level, what's going to continue to happen at the state level, and what's going to continue to happen here in Washington, D.C., I think policy is a real issue for a lot of folks in this industry. As you said, if the definition of an institutional investor is any entity that owns 100 homes, that's a pretty low threshold There are a lot of mom and pops out there who own 100, 200, 300 homes who now all of a sudden find themselves in a situation where they're going to have to comply with the provisions of whatever bill comes out in DC vis-a-vis that definition. So, like I said, I'm not sure the legislation that we're going to see in DC is going to be terribly restrictive, but I do think it's going to sweep up a lot of owners into what's going to be expected of them, what's going to be allowed in terms of what they can do moving forward. And I think that's going to be something to watch for sure.
Yeah, it's too bad. And it's, because what we want is for families to be able to have a single family living experience, so these restrictions are really counterproductive. It's just me talking my perspective on it. I really think that it just deprives families of something that they need. They want to have a yard for their kids to play in, for the dog to roam around in, and for parks nearby, good schools, all those kinds of things.
Well, and as I said earlier, I think what's really needed, given where we are in terms of supply and affordability, is an all of the above approach. We need to try everything. And, when you think about build to rent, I think build to rent has been one of the real innovations in the housing space over the past 5 to 10 years. Andrew and Matt can certainly speak to that. But again, as I see things, housing development really, the building of housing really hasn't changed a whole lot in the last 40 or 50 years, right? How homes are built, how homes are financed. Build to rent really is something different. And that, a lot of that, and now I will admit people have been building homes to rent forever. That's certainly not new, but doing it at scale, doing it in terms of building out communities that are for rent. There's a lot of real innovation there. And a lot of that is due to the presence of institutional capital, the emergence of institutional capital getting behind build to rent and really sort of providing the momentum that sector needs to, as you said, Brad, do some good, which is giving housing consumers another option. I mean, look,
Mhm.
I rented a single family home in Bethesda, Maryland years and years ago. That was, 67 years old. Things were always breaking. I could never fix anything. I would have loved to have lived in a brand new 3 or 4 bedroom single family home in a community with walking paths and a little pickleball court. And anytime something went wrong, I could call or get online and ask the management company or the owner to come and take care. I would have loved that. I mean, it's a great innovation. I think it's good for housing, and I think it's good for people who are looking for housing.
It fills a niche, and to a degree, there's always been for 10 or 12 years there was pent up demand. Every time a new build to rent development opened up, it filled up immediately, and I think we're going to get back to that once we kind of get through the current oversupply that's existing in certain areas. But yeah, I think that it's a shame that both sides of the aisle, the Democrats and Republicans, and are kind of hanging on to this populist sort of view that, hey, these guys are taking away homes from people that ordinarily would buy them. But what about the people who can't afford to buy a home? They don't have the cash for a down payment. They don't have the credit score, but they want, and I think deserve, to be able to live a single family home experience. And
There's so many people nowadays that have bought in 2021, 2022, and now cannot sell their homes. I am personally in that boat, and I have to say, renting a home looks far more attractive than it ever has. And so there's a lot of people that have tried the home ownership, seen that it's hard to build equity, especially in this environment, and they want to go back into renting by choice. And so, with an aging housing stock, a build for rent, a brand new, professionally managed community with tons of amenities is the best option.
yeah,
Typically,
go ahead.
problems of this scale, the affordability kind of crisis that we have from a shelter perspective in the country, these things tend to get solved by private capital, right? I mean, you look at the corollary right now in kind of the grid where typically government would be involved through the utility companies. And now you're seeing all the private, tech companies jump in and provide their own energy and source their own solutions there. I think it's the same, in the housing environment. It's incumbent on us as an industry to deliver entry level product that's, available to the masses, that satisfies median income consumers. And we'll show legislators both at the federal level, who I think seem to understand the purpose of delivering supply. That's why they've made this carve out. And then at the state level, the localized impact that has and what it provides to their constituents. So I'm not an optimist by any stretch, but I'd like to think kind of the data will rule the day, and the logic of delivering a product that's good for these municipalities is ultimately to allow this industry to carry forward in a good way.
I think, Brad, the one thing I also want to highlight, independent of any legislative items, is that the industry is also the building industry and the really new construction industry has become reliant in a lot of ways. One of the ways that they're able to continue to deliver housing in the U.S. at this point is that by partnering with a number of institutional partners to be able to build a 300 unit community, whereas they might historically, most builders will not build on spec at this point after the financial crisis. So generally, they're very staged in the way that they deliver units. What's one thing that's accelerated the number of units that's been able to come through is the innovation of partnering with some build-to-rent operators, where you feel comfortable now proceeding with a 300 unit community because you've already pre-sold 150 of those units to a institutional buyer. Therefore, you're able to accelerate those 150 units that come to the market, and then go on to the next community and build again and recycle capital and continue through. So that is something that I'd say over the last few years also sort of the space has developed. And right now, a lot of the public builders, if you've seen what's happened with them over the last, let's call it the last 6 months or 9 months, as they were in a sort of very good period for a few years, very high margin, very high velocity sale environment, entered into a space where it's a little bit softer. Now, even more so, is a time where they're leaning on institutional to fill in some of those gaps and for them to continue the same delivery. The more they deliver, the lower their cost of capital, the lower their labor costs are, better supply. All of these things factor into what's the overall cost of housing in the U.S. So that new component, which has come over the last few years, is a real catalyst to continue to build in the country at this point. So I just want to highlight that as another point that's not spoken about a lot at this point.
Yeah, that's right. And a lot of the builders, when they're down to their last 15 or 20 houses in a big development, they want to just close it out and move on, redeploy their capital into the next big master plan community or subdivision. And they just want to sell those to an operator. It would be a shame too if that was kind of caught up in all this legislative restrictiveness that's being discussed.
At the same time, I mean, what this new world order could instigate is just more intentionality, right, of the product. Thinking from the outset that you're going to create a rental community, building it accordingly, creating a basis that allows folks to rent these out at rates that are attainable for a consumer. There's good and bad of placing restrictions on private capital, of course, but I think the key is, the industry has to react and use capitalistic instincts to bring down costs of materials and change practices to get more efficient.
Yeah. By the way, talking about the builders, either Andrew or Matt or anybody, are the builders offering any discounts? I know they're struggling by and large to get sales, or they're having to do these big, expensive mortgage rate buy downs to get their sales. Are they coming out and saying, hey, we've got some units we want to sell or we want to build on a forward contract basis? And if so, are they offering reasonable terms nowadays?
Yeah, it's interesting from our perspective, probably surprisingly to everyone on this call, 23 and 24 were pretty good years for sale home building, right? Despite the very high mortgage rates. And so I think the builders, enjoyed that and rolled into 25, expecting a bit of more of the same. And ultimately they saw a softer environment that well ran dry a little bit in terms of that demand. The affordability pains are continuing to poke through, not just in housing, but in other areas that are pressuring consumers. So towards the end of 25, builders started to sharpen their pencils towards, how they could come into this BTR channel in a differentiated way. And you're certainly seeing that in 26, where they're not waiting around to find out if the spring selling season is going to make or break their year. They're really trying to be, like I said, intentional about how they plan for their business this year and next year in terms of pre-selling communities or building to a rental spec to make sure that there's inventory enough. And that is manifesting in some price concessions. A lot of the sticker prices that are available to consumers, if you look online, aren't even the real price that are being transacted at. To your point, there's a lot of incentives out there. There's mortgage rate buy downs that they're using. There's a lot of tools in the toolkit for builders to, work with both consumers as well as institutions to create a a rental community format at price points that are, lower than where we've seen prices in the rear view mirror.
Yeah, you're right.
Brad, our clients are receiving large tapes from a number of the national builders on a scheduled basis and asking interest and indication of interest across the country on hundreds of communities across, and taking in inbound activity from institutional investors of how to solve for some of that excess inventory or just a more forward planning strategy. I wouldn't even put it in a necessarily in a pressure standpoint, just more of a, as I was getting to, how do you plan appropriately? And you say, I have X number of starts. Do I feel comfortable taking a new land position before I have X number of units sold? So it creates, again, the circular reference within reason. If they can sell that community out in a bulk basis, they now feel comfortable taking down the new land positions, and then therefore we'll have more inventory in 27 and 28. Right now, if they don't have that certainty, I can assure you one thing will happen is if you don't have that certainty, your land positions will come down. And in 27, 28, and 29, we're going to be sitting here talking about why there's not enough new builds and inventory coming to the markets. That's what I would just very much focus on, of how do you keep the really pipelines active? And there's all of these different tools you can use to do that.
What's fascinating about our industry versus other commercial property types is you tend to get more transaction volume, even through periods of dislocation. In commercial real estate, you don't have any forced mechanism for buyer and seller to come together, and there are fund parameters and other debt maturity things that can instigate sales. But there's no real gun to the head in terms of sales. Home builders are in the moving business; they're not in the storage business, and so. To Matt's point, what comes in on the front end of land, ultimately has to go out as a finished product, and they can't shrink the land pipeline to zero because there's corporate overhead, there's jobs, there's things to keep the sort of lights on, and so you get this liquid market, you get this motivated transaction market both from seller and then ultimately buyer, where they like to transact with sellers who want to sell. So there's a baseline level of demand from both sides.
Right. It makes me think about another question, which is the financial metrics for new development BTR deals. So, we were hearing, I guess, a year ago or so that capital wanted to see a 7% yield on cost to do a new development. And I think I started hearing about 6.5%. And I guess it depends on the location. And then also curious about exit cap rates. And, I'm hearing like 5 to 5.5% for exit. Do you guys have any perspective on what those numbers are doing these days?
Yeah, I mean, from my side, I'd say, capital has remained fairly disciplined. Equity capital has remained disciplined, and hasn't stretched too much on the development side. It's why you're seeing, the development pipeline shrink and the forward supply outlook start to look a lot better from a fundamental perspective within BTR. Where people are stretching down from kind of that academic spread that you want in terms of a 7% yield on cost on a development relative to where you can borrow on a permanent basis, that's tending to happen in some of the markets that are lesser supplied. So some of the secondary markets we talked about, or satellite markets to the core MSA. So take a Lakeland, Florida versus Orlando or Tampa, which it sits in between of. You get more affordability in that market, and as a result, you've seen more product come into those channels. And that's where I think people are willing to accept a less than academic return and move in perhaps from a 7% demand in terms of their return on cost to something like the 6.5.
Yeah. And hopefully if long-term rates do come down a little bit, and I don't expect them to come down a lot, but if there's any relief there, then that should bring down the hurdle rates a bit, and that should be helpful. Coming back to you, Audrey, I'm curious, what has been the biggest surprise for either you or the market in the last year? What's taken you by surprise, or maybe our clients?
Yeah, it really goes along with this affordability crisis that we've been talking a lot throughout this whole webinar. Is retail product is now starting to adapt to look a lot more like build for rent product, which is great for the build for rent industry as a whole because the delta between those two product classes is starting to get a lot smaller. And that goes along with this trend of consumers are feeling the crunch when it comes to living costs. And so attainable, more affordable product in the build for rent side and in the retail side is definitely having a major moment right now. So in the past couple of years, we've seen a big trend towards 3 and 4 bedroom build for rent homes. That's the majority of what consumers are typically looking for. Now, in this past year, one of the biggest surprises is we've seen that kind of ratchet back a little bit. People are still very much interested in a 3 or 4 bedroom home, but it's that caveat of if they can afford it in the market that they're looking for. So you are tending to see the units that are smaller, whether it's 2 bedroom or still like a really small 3 bedroom, those tend to see the higher absorption and fly off the shelves, versus the higher square footage 3 and 4 bedrooms tend to take a lot longer time to lease up. So that's just very tricky, and developers that aren't taking that into consideration and they're still building their typical 3s and 4s that are maybe pushing 2,000 square feet, those are the communities that are taking a major hit right now in rental values as well as absorption and occupancy. So that's definitely something to note. And also when you're looking at marketing a build for rent community, including some of those more competitive, smaller square footage units can actually buffer your absorption and create a bigger push into the market because you are coming to the market at a more affordable price point than your competitors. So I think that's been the major needle mover that we've seen for looking at communities that are definitely performing higher in a lot of markets, both primary, secondary, and tertiary.
And it kind of goes to differentiation, right? We've got a market where there's supply competition from SFR and multifamily. Just kind of real quickly, what are some things that developers should do, either for Audrey or anybody else? What can they do to differentiate and get more sales or more leases?
Yeah, I would say there's a few different triggers that you can pull. Product is going to be the biggest thing. So design, how can you take some of the costs out of your design in order to point to consumers? But you have to be really smart with that. You still have to have super functional floor plans that may have less square footage, but they may still have that livability and feel larger than they are. This can also be done with very unique design and different finish level choices. But I would also say the biggest factor is your property management strategy. That's where we see the differences between highly successful communities in highly competitive environments and the ones that are not doing so well. One thing I've seen very often is there's a lot of push towards virtual leasing agents. So when potential tenants are calling these communities wanting to schedule a tour, or potentially just lease a unit, they're met with virtual leasing agents, which is very bad in terms of how they're appealing to these residents, as well as if you're already living in these communities and you have to go through a virtual agent every time you need something fixed, that tends to look very poorly as well. So how can you make sure that your residents feel valued, but also make sure they are feeling that they are getting a lot of value out of this community that they're renting in as well?
Well, I think I'm going to just wrap up with a lightning round question now. I'd like to have each of you give me one word to answer the question. What should let's start with
Probably building a little bit on Andre's, like, how do you deliver a price point? I'm very bullish on the total growth in build to rent.
so
How do you deliver
affordability,
the
value.
Yeah.
Okay, so
So
value.
the value to multifamily. It doesn't mean you need to be cheaper than multifamily. Is there a value proposition that resonates that a resident's willing to pay an extra few $100s for?
I like that. That's very smart to draw that distinction between just affordability and value. Value is key. Andrew, what do you think? One word. What should we be thinking about?
Yeah, I mean, the only word that matters is affordability.
Yeah.
I think, the key is just matching that affordability with what Audrey described on the livability of the product. As she was speaking, it came to mind a project I saw recently. It's in an exurb of Raleigh, so, a bit further out. And then even within that local community, kind of on the outskirts where land is readily available. And it's north of 160 units in this project, all 3 bedrooms, 3-story townhouse with 1-car garage, and in other units, no garage. And I just sat there scratching my head saying, why are you building an urban product in an ex-urban location? It's just not going to lease up. It's not going to get the interest of the consumer. Ultimately, what will happen is that will have to trade at a price where maybe the rents come down so cheaply and it delivers, some value to the consumer, but that value will purely be monetary. It's not going to be the livability. So I think our industry really needs to do a better job being intentional about what's being built where, because that product works really, really well in the inner corridor, and it's a way, it's a way to deliver supply to the interior as well. But it really has no business being out in the exteriors.
Yeah, and that's the whole reason that build to rent, it's affordability. You can rent a single family home for dramatically less than the cost of ownership, and that's been well documented. Everybody's aware of that. So affordability is key just for this whole sector. And Audrey, how about
Yeah,
you?
mine would be optimization, making sure that the product that you are building is so specific to your tenant base and what they're looking for in the market today, which covers what Andrew and Matt said as well, is it's got to be attainable, it's got to be affordable. So just getting real specific on how you're optimizing your communities.
Yeah, absolutely. You got to optimize. So with that, I'm going to just kind of throw out a little recap of some of the things that were important that I heard in our discussion today. Number one, we all agree, both sides of the aisle, red state, blue state, Democrat, Republican, everybody agrees we need more housing. Everybody agrees affordability, to your point, Andrew, is issue number one. We have to figure out how to address it. BTR is a great way to address it, and need more housing. That is addressed directly by BTR because it's right there. It's right there in the name, build to rent. And so you're not taking away supply from anyone. You're adding supply. That's a key point. And we heard from Andrew about the secondary markets, Kansas City, Lakeland, Raleigh, you mentioned. There's a lot of opportunity in those markets. We're hearing that the equity is kind of gradually poking their head out. Matt gave us a good perspective on that. The executive order, it recognizes the need for BTR and more supply. And thank goodness for that. We got to watch the bills that are going through the legislatures in Georgia, Virginia, Tennessee, some of these others, where they are not, unwisely, they're not carving out BTR. So that's creating a problem for a lot of families that really could use that lifestyle. We already heard that, they're defining institutional too broadly, 100 homes or more. That could be a big mom and pop operator. And unfortunately, the vast number of the groups that are going to be hit are going to be those kind of modest sized groups, not huge institutions. So again, final word from me is the carve out for BTR is crucial. BTR helps to add supply, and it helps families that need that alternative. Thank you for helping out with this, everyone on the panel. And Gregory, thank you for hosting this, and I'll kick it back to you.
So when I hear value, affordability, optimize, and a BTR carve out, I mean, it's critical, right? Supply is needed. The leaders remain bullish on fundamentals. And when institutional capital moves first and fast and responsibly, it can deliver housing at scale and do good.
It's needed. It's absolutely needed. People that have kids, have dogs, people like David is an example, Audrey is an example, people on this panel are part of the group of people that could benefit from this kind of supply. It's needed in a lot of markets. We're going to be back to a pent-up demand for BTR within 2 years.
Brad Hunter, thank you for leading this important conversation. Thank you to your panelists, David, Audrey, Matt, and Andrew. Brad Hunter of Hunter Housing Economics. We hope you'll come back again real soon.
Thank you. Appreciate it.